Hello, and welcome to this webinar entitled Rising Renewables, Navigating the Increasingly Challenging US Power Markets. I'm Stella Farrington, and I'm Head of Content for Energy Risk, which is a risk.net brand. So we've gathered 5 brilliant panelists for you today, and they'll be addressing a wide range of topics, including issues faced by investors and developers when getting renewable energy projects off the ground, the challenges involved in hedging and trading renewable energy, the operational challenges associated with markets such as renewable energy credits, and the difficulties of operating in a power market when there is just so much new renewable energy coming onto the grid. So to put this in perspective, I've got a few stats to start us off with. So over the last decade, the percentage of US electricity produced by renewables has doubled from 10% of total electricity production in 2010 to just over 20% in 2022. Last year, a record amount of new solar capacity was installed in the US. From June of last year to June of this year, 17.6 gigawatts of new solar capacity came online, bringing US utility scale solar capacity to 65.8 gigawatts, and that's according to numbers from the EIA. In terms of wind capacity, in June this year, the US had 137.6 gigawatts of wind capacity, 10% of which was installed between June last year and June this year. So that really goes to show the speed at which these projects are coming online. And at the time of writing, the EIA expected another 7 gigawatts of wind and 13 gigawatts of solar capacity to come online by the end of the year. So to discuss this, the impact of this, look at what's to come next, we've gathered, as I said, a brilliant lineup of panelists. Each one has a huge amount of experience in the sector. They bring really different expertise to the table. So we're going to have a really rounded discussion. We do welcome questions from the audience, so please do type them into the chat box if anything occurs to you, and we'll endeavour to answer them as we go. So I'm going to hand over to our panelists now. And I wanted to sort of start by setting the scene and looking at some of the recent trends. There's been a lot of rapid change in the last couple of years. So I'd like to start by asking you, or each of you, if you could sum up how the last 2 years have been for you. So could I please ask you to introduce yourself and your company, tell us what sorts of things you've been working on over the last couple of years or so, and what trends and challenges you've encountered. So could I ask Jazib, please, to kick us off?
Hi, thank you, Stella, and welcome everyone. This is Jazib Hassan. I'm a managing director at EIG. EIG is a private equity, private credit fund that's been around the energy space for 40 years. We're one of the oldest players in the dedicated space. We invest across power, renewables, energy transition, as well as some of the traditional energy around upstream and midstream. So we get a very holistic view across the energy spectrum, and then we invest across the capital structure as well. We have equity investments, we do a lot of pref mezz structure, and then we have a very significant direct lending business. So again, looking across the capital structure allows us to sort of think about how each of these has been evolving in the last few years, and where the opportunities are and where we are focused on. So with regards to focus, obviously, in today's immediate environment where energy and commodity prices have rallied a lot, there's interesting opportunities in the traditional energy space. But a large driver for us also is looking out ahead and thinking about what the energy transition requires. So we have been making all kinds of investments in the renewable energy space, particularly solar and storage has been a really important space for us in the US, and we have invested that across the globe as well. Very significant investments in Europe and in South America as well, across the different types of renewable energy assets. And so, given what's been happening both in terms of the energy transition and the need for capital, as more and more money is going to these new assets, as a lot of coal-fired plants are being decommissioned, we're seeing opportunities from that, both in gas and renewables. And then at the same time, we're seeing interesting opportunities arising from the energy stability that the market is requiring. What's happened in Russia and Ukraine has put a laser focus on Europe's energy stability, which obviously has connotations for what it means for us in the US as well. Not just the direct, like, hey, we can provide LNG to those markets, but as we think about the world, 5 years from now, 10 years from now, what does stable, reliable energy looks like? What does that platform look like? What's a good spectrum of investments to make in? So that's kind of what we're doing at EIG. For completeness, over the last 2 years prior to EIG, I was at a smaller renewable energy fund, Modern Energy, where we were investing in early stage developers being asset creators in the renewable energy space so that we can find platforms and find the right locations. We felt that location was really important for where assets are placed. So how can we be the asset creators? So that was a big part for us about a year or 2 years ago when I was spending time looking at that. My broader background has been spending a lot of years, at banks, almost 20 years at different banks on the project finance side, as well as commodity power trading side. So holistically looking at what banks can do and what hedging looks like and how's that impacting the markets has been a daily job as we try to figure out what the best values are. Team-wise, Stella, as you had mentioned, one of the things we're looking at is the energy stability, what's happening in the nearer term. But longer term, we're really focused on how do we make, there's more electrification taking place. What are investing on two fronts? One are the large scale, utility scale assets. And then the other place we're spending time is the distributed generation side of the business, where we feel that assets that are close to loads have some natural advantages and value. You don't have to spend as much time figuring out regulatory challenges associated with transmission, and then you put the generation next to the load. And then obviously the variability that exists in renewable generation naturally puts storage as a key part of that equation. So we've been investing in storage assets and thinking about how storage assets coexist with renewable generation. So that's kind of some flavor around where we are, how we are sort of thinking about it. I know we're going to spend some more time on some of the challenges, so I'll pass it on to the next speaker, and we can pick up some of the other challenges that we see.
Brilliant, thank you, Jazib. So could I pass the baton to Rohit, please, now?
Sure, thanks, Stella. Great to be here with you and with all the viewers and participants in the forum. I'm Rohit Ogra. I am a co-founder and senior partner at Treaty Oak Clean Energy. Treaty Oak is a full suite development platform for solar and storage across the US. Previously, I was a co-founder at AP Solar. AP Solar was an early mover in ERCOT in terms of siting solar generation closer to load. And so we were an early mover in the Houston load pocket. We started development in Houston in 2018. And fast forward about 4.5, 5 years, we've done 1.6 gigawatts across 4 large grid scale projects in the Houston area. So following onto the theme of being closer to load and taking advantage of better transmission, I've been in the energy space for 17 years, focused on power and gas in the US. Been at a couple of banks in trading functions, run an advisory business for a few years prior to starting or co-founding AP Solar in 2018. And Treaty Oak was, as a follow-on of AP Solar, was founded earlier this year. In terms of where do we spend our time, I know, Stella, one of the questions you asked in the introduction was, what are the trends and challenges at a high level that we're seeing? In terms of trends over the last couple of years, we've certainly seen more merchant risk, sponsors and projects taking on more merchant risk, driven by various factors. I think early movers experience significant settlement risks off of the hedge products or the offtakes that they were entering into. And so there's been a move towards more merchant generation to try and take advantage of scarcity events that we're seeing happening more frequently in various markets across the US, certainly in ERCOT, but in other markets as well. Some of the other trends that we've noticed that we sort of follow closely are, financing structures have changed significantly since Storm Uri, which happened in February of 2021. We've seen lenders lend to more, getting comfortable with more merchant projects. We're seeing some changes in tax equity structures as well. We've seen some, and now certainly with the IRA passing, I think some new laws, we're going to, it's something we're tracking very closely in terms of how financing structures might continue to evolve with some of the extra incentives in the IRA. Some of the other trends that we're following are we're certainly keeping a very close eye on battery development. We're doing battery developments, but the traditional markets where we've seen a lot of battery proliferation has been, for example, California, where there are significant capacity payments. But we're trying to understand what are the different revenue streams that batteries can take advantage of in various markets. And it's not a one size fits all or a sort of a hammer and a nail situation. So we're trying to understand what makes sense in which market, what use cases, and how to size those batteries. Batteries can be a 1-hour battery, can be a 4-hour battery, can be longer duration. So what is the need in each, what are the idiosyncratic needs? And then, like Joseph said, one of the things we also are looking at is what are the changing load patterns? If there is a mass adoption of electric vehicles, when are they going to charge? And how does that change the load patterns? How does that change generation dispatch in various markets based on that load profile? So that those are sort of some of the trends. And at a high level, you asked about challenges. Transmission continues to be a challenge. What we see in our markets is, fortunately or unfortunately, a lot of developers and sponsors, owners of project follow the resource, whether it's the wind belt or areas where solar has high irradiance factors. But those areas tend to be away from load. And so there's some significant transmission challenges that sort of dynamic presents. And then the other challenge that we track very closely is on the procurement side. The supply chain, the procurement challenges when it comes to solar and storage. So those are some of the key challenges that we're very focused on.
Okay, brilliant. Thank you, Rohit. Jonathan, could I ask you to come in next, please?
Sure. Thank you. Hello. Thank you for having me as part of the panel today. Great to be here. I've spent about 18 years now in the energy sector, but in the past few years, I've moved from basically what I would say is the generation side of the business. How do you take, for instance, renewables to all the different channels to the market over to the retail side of the business? And so currently, I serve as head of wholesale trading and origination for Inspire Clean Energy. Inspire Clean Energy is now a 100% wholly owned subsidiary of Shell. We focus on the B2C side of the business, so business to consumer. So our customers are residential and small commercial. I have two primary functions, one being to hedge our energy supply in the market, so anything from power, gas, RECs, carbon offsets. My secondary function, and one of the core reasons that I made that move from the generation side to the retail side, is in what we call structured origination, which spans structures from hedging our load following risk with customers to securing offtake from renewable generations. That renewable generation is one of the greatest challenges and opportunities that we see in the market, where really when you look at bringing kind of renewables, bringing the locality and quality of renewable purchases into the hands of consumers, that has been kind of a secondary focus of the market, I would say, over the past couple of decades, as we've moved from, long-term PPAs that were focused on utilities, even banks, corporate customers, really to how do you take those into the hands of consumers and basically offer that higher quality product. So a lot of challenges and opportunities around that. If I take kind of a step back, the other panelists have already hit on this a little bit, but there's been a great deal of change in the market over the past years, whether that's the start with Winter Storm Uri, just general increase in volatility and commodity prices that have kind of skyrocketed in different markets, exacerbated by the Russia-Ukraine war that's put kind of a supply constraint on natural gas, but that trickles through because everything's linked through the global markets now, to just supply constraints that have hit the build out of renewables and how that's impacted basically the generation stacks in these various markets. When I really look at the focus and as I said, those opportunities and challenges, understanding the risks in your portfolio, having the operational capabilities and financial resources, those are paramount, especially in times where having the right balance sheet, understanding those risks is just absolutely key. I could dive deeper into some of those opportunities and challenges, such as the supply chain, meeting the push towards 24/7, the recent IRA, but I know we're going to build on that later in the session. So I'll defer on those pieces for now. But thank you for having me.
Yeah, absolutely. We'll come back to all of those later. So thank you very much, Jonathan. And could I bring in Joe here, please?
Hey everyone, how's it going? Joe Catarella. I'm a partner at Baringa. We're a global management consulting firm. I'm part of our energy and resources practice based here in the US. Our key focus areas in the energy resources space when it comes to renewables is we have a market fundamentals group that really helps go out and model all of the US as well as all of the globe to figure out more of the long-term power prices. And that obviously takes into account all of the new generation new assets that are being built out in all the different markets, as well as the new technologies of battery, et cetera. And then the other piece that we're focused on is around the commodity trading, energy trading aspect, and helping clients transition, to operating in this new environment. The prior panelists obviously went into great detail of one of the challenges and whatnot, but I think, the key thing that we're seeing is around 5 years ago, there were long-term PPAs that were being contracted in order to fund these being developed. We're seeing those contracts kind of shorten in length, a lot of these going merchant. I think some of the older facilities that were built, right, they're now running into operational risk that maybe wasn't expected due to congestion and new assets being built to there. So like we're helping clients try to figure out what their short-term trading strategy could be to mitigate those risks. Obviously we talked about the IRA and, from an investment side, what that's going to do. But, we'll kind of hopefully take a deeper dive into a lot of these topics so we can kind of move forward.
Brilliant. Yeah, thanks very much, Joe. And finally, could we come to Sinu, please?
Hi, everyone. This is Sinu Kalyamurthy, and thank you for having me on this panel. I'm excited to talk about, what the systems aspect of, of this whole power and renewables, the evolution that is happening in front of our eyes. I work for Enuit, and Enuit is a ETRM system provider. ETRM is energy trading and risk management. We provide systems to energy market participants to manage their trade booking all the way until settlement and accounting. So the last couple of years has been extremely exciting for us, and especially myself. I lead the power and renewable space, and there's been a lot of there's a reason I picked up both of those, because they're really intertwined, and there's quite a bit that we've been doing in revamping our product to handle the changes and the challenges that are coming with it. And starting with power markets. Power markets have gotten, with the advent of renewables, it's gotten a lot more granular. The analytics have, the need for more granular analytics and more bespoke analytics that our clients want to do, in order to tweak their generation dispatch model, for instance. And so we're working on providing those capabilities to our clients. That way they can deal with the challenges, with I know these are challenges as well as opportunities. So a lot of people, when they invest in technology and they have these capabilities, they see it as an opportunity that they can go out there and do things that some other people are not able to do because they have more analytics capabilities. And also renewables, and there's a lot of bundling going on between the actual physical commodity like power and the renewables, and we're building, again, capabilities to track those renewables, tracking those renewables standalone itself could be a challenge. If you're just dealing with just spreadsheets and so on and so forth, you need some good system to deal with it. We can talk about that, I guess, in the panel a little later. So those things, and another area that we are, putting in a lot of investment is FDRs. We talked about, I think Rohit talked about transmission constraints, transmission challenges. So when there are transmission constraints, and now there's evolution in that market, the congestion market is a pretty important aspect, congestion pricing. And a lot of people want to hedge it, they want to do FDRs, but FDRs is not a very easy instrument to deal with in an ETRM system. So we're investing a lot in that area, and then trying to build out our capabilities, which is, I think, unique to Entrade, our product. I think, so we're investing in these areas. So I'll be happy to talk more about this as we go. And I'll hand it back to you, Stella.
Great, thank you very much, Sinu, and thank you to all of you. You've really set the scene well there, and I think what I'm hearing overall is that there has been an awful lot of change going on, some of it for external reasons, from Storm Uri right through to Russia, Ukraine, and supply constraints and difficulties with even getting supplies for renewable build, etc. And right through to the other side of things, like the market side with more volatility in prices. So I think what I'd like to do first of all is look at the side. Several of you spoke about the evolution of financial structures and how risk appetite is perhaps changing. PPAs, people are perhaps becoming more comfortable with more merchant risk now. So I wanted to start, if I could, with Jazib and ask you this question. So as more renewable assets come online, they are going to start obviously having a greater impact on price. How is this impacting investment decisions? And could you also talk about the changing appetite from merchant risk towards merchant risk and away from PPAs?
Absolutely. Super important, super relevant question, right? As we see more and more renewables coming online, it just, the impact on the supply side of the equation is something that we and other investors are very focused on in terms of thinking about what does long-term pricing look like. Now, nobody really knows what long-term pricing looks like, but we can all try to sort of, have some views around it, and that has an impact on our investment decisions around the types of risk we want to take or not take. So if you look at the evolution of the renewable energy market and the financing for it, we started off with like long-term PPAs, 20, 25-year PPAs, and that was the norm. And then that went down to like 10 to 15 years. People were comfortable with that. And then more recently, last year, we were seeing stuff in the 5 to 10, 7 to 10 year context. Not only banks were comfortable, but tax equity started getting comfortable with a lot shorter tenor and being willing to take a lot of merchant risk. One of the drivers was Hurricane Uri, where people who had hedged and had these long-term contracts and stuff were hurt when they couldn't generate. So a lot of the market players were like, wait, if sometimes it's not bad to have some merchant exposure, you really don't. If you're fully contracted out, that could actually hurt. So there was more willingness and appetite in the market to take some of that merchant risk, and we started seeing that. Today, again, it's an important question. The market is evolving a little bit with rates going up and credit spreads widening and concerns around maybe Europe's high likely going into recession. There's US going into recession. What does that mean for prices and margins? Should we be taking less risk in the teeth of those? Should we take less merchant risk? So there are more questions today than there were 6, 7, 8 months ago. People are asking what is acceptable and not acceptable. I think when it's a generation asset, I think there's a little bit more appetite for that merchant risk. There's a lot of demand on the solar storage side for market participants taking merchant risk, but that becomes challenging for capital providers because we look at it and say, hey, part of the reason you're putting the storage asset is because there's an arbitrage and you can take advantage of the arbitrage. But the fact that now you and others, if you're going to be putting a lot more storage assets, that takes away the arb. How long will that sustain and the value that you were looking for in a merchant case is more challenging. And then ancillary revenues have come in, and that again was something people were relying on for merchant deals, and that's been challenging. And then when we think about what's happening in the capacity markets, which I think somebody asked a question from the audience around capacity market and how we think about those. And I think PJM is a really interesting example where the market had assumed capacity prices would be much higher, and then it came down in terms of how people were bidding in and new renewable and other assets were coming into market, and that prices collapsed materially in that capacity market. Does that mean the same thing for other assets? That's because we have real history around the capacity market, and so that's we're trying to get arms down and saying how comfortable are we. Whereas so when somebody like me looks at it, I say maybe a solar plus storage asset combined has a better risk profile than a storage standalone asset. So there are ways we are trying to mitigate some of that risk, because we do see storage being a key part of what the world will look like in 10 years, where renewables still are intermittent. So you do need storage, but what's the right way to finance it? Maybe alongside other asset in a slightly different business model works a little bit better than just a standalone storage asset.
Okay, thank you, Joseph. And thank you for addressing the audience question as well. And I'm going to read that question out and put it to Rohit too. So the question is, as ISOs revise capacity accreditation, which lowers future capacity revenues, and renewables continue to cannibalize their own energy revenue over the next decade, do you anticipate the further creation of new non-energy market products to incent new renewable build? And if so, will this be a regional solution or more of a patchwork state solution? What do you think, Rohit?
Yeah, that's a great question. If you look at resources today in capacity, in markets that have capacity like PJM or MISO and other markets, a renewable resource has three major sources of revenue. It's selling energy, it's selling RECs, and it's selling capacity. What this question is referring to is the fact that as we have more renewables, but especially solar, that starts to eat into the peak, some of the peak hours in most markets, what we call the ELCC, the effective load carrying capacity, goes down because the load pattern, the load shape is shifting. And so that's what is being asked here, is that if capacity revenue goes down and energy revenue goes down just as a function of how much is on the grid, and further in markets where there is a tremendous proliferation of renewable resources, be it wind or solar or combination, a lot of that is driven by the RPS programs that have been put in place. And the RPS programs tend to create a product called the REC. And so if you're meeting those RPS goals, eventually the REC also might not be as valuable. And so the question is, well, how does a resource make its revenue? And that's a great question. I think, like Joseph said, it's hard to know where you're going. So what are the things we look at? We look at strong fundamental locations from a transmission perspective. We think that regardless of which world you're in or which regime you're in, you want to have assets that are more valuable than perhaps others that are situated in the wrong location on the grid. But further, if the question is, well, how do you create a structure? I hate to say it, but one answer could be that we go back to a regulated market where everyone is earning earns a regulated rate of return because the energy is needed, and then so you kind of go away from this hourly or sub-hourly sort of shape discussion around what is the ELCC or when are you producing the most valuable electrons. So that's sort of how I think about it. In terms of other new products that could be built, it's hard to know. I know that Joseph talked about batteries being paired with perhaps solar projects to take advantage or to be able to take advantage of the ELCC. Typically in California, for instance, if you have a 4-hour battery paired with solar, I believe you get 99% of your nameplate capacity is eligible to receive a RA, a resource adequacy payment, which is basically a capacity payment. But the fact is, if you fast forward in that model, you're just shifting the problem. So eventually, you are saying if there's a proliferation of 4-hour batteries paired with solar, eventually you'll need 6-hour batteries and then 8-hour batteries and then really long duration 10 to 12-hour batteries. So I'm not sure that pairing storage with solar is the panacea here, but it's certainly a good question. I think the view we take is it's somewhat unknown, but as long as we continue to build in locations with good transmission and markets with good fundamentals. So what are those markets? Those are markets that don't have as much renewable penetration today. You get a much longer runway in terms of what your revenue profile looks like.
Okay, thank you, Rohit. Jonathan, could I ask you to come in now? And I want you to also talk about how you're seeing things moving in terms of risk appetite, what people are comfortable with now, in terms of merchant risk, and also it's come up a lot already now about the REC markets. Could you talk about your experience in there as well, please?
Sure. So a few pieces there. One, I think it was an interesting point that was just brought up around storage and the California market where there's multiple sources of revenue streams. I think one of the biggest evolutions I've seen over the past years is one, the diversity of build of like storage with solar, but then also standalone storage where there is that additional merchant appetite that's been spoken about. And so you can more opportunistically look if you're on the development side and say, what do I want to lock in versus what do I want to leave open? What may be priced advantageously in the market and what's not, whether it's capacity, energy structures, ancillary structures. And so I think that's one piece that was just touched on that is definitely evolving. I think a lot of the structures are still being worked out as to what works and what doesn't. So that's a little bit just on the storage piece. Turning back to renewables for a minute and the evolution there, we've already talked a little bit kind of the move from 20-year to 10 to 15-year, even shorter duration. That is actually, coming from a retail seat now, been one of the capabilities that's been unlocked for us is we have much shorter term customer contracts. And so the ability to actually contract those assets under shorter term, less than even 5 years now, to gain direct access to the renewables, where we couldn't have contracted under a 10 to 15-year PPA, has been one of the biggest shifts because of that increased appetite from multiple players across the market, whether that's your investors, whether that's the renewable developer, whether it's some of the trading entities that are even, had very robust capabilities on, being market makers in the market, actually deploying their balance sheet now to acquire renewables, are basically able to take on more of that, for instance, back end of the curve merchant risk, lay off the front end under 3 to 4 year structures, taken as produced from a facility, firm it up, take it to the zone instead of being, the as produced nodal PPAs that the market started at in the early 2000s. All of these things are adding together to take these to different channels of the market, where more players are basically getting access, more consumers, whether it's corporates, whether it's the utilities, whether it's the consumers, I think is a huge kind of evolution there. We are seeing, technologies layered on top of each other, basically in this move towards hourly matching or 24/7 as, kind of the buzzword in the market right now, is another key kind of development area on, how do we actually pull these technologies together, pair them, and actually get that where it better matches load in the market. There's also been the wave of innovation in terms of transparency for REC and emission tracking. That's kind of been over the past, I would say, 5-6 years, there's been just quite a bit of moves there, and also demand from the market side in terms of that transparency. You asked very specifically about RECs, and that is one of the core pieces of my business now. RECs have challenges and opportunities both from a commercial perspective and the technology side. I'll start with the commercial side, which is we're just seeing a wave in the market towards higher quality. Locality is becoming important from both the consumer perspective and regulators. Regulators asking, why are you not procuring more RECs in the state where you're serving those customers? And so there's a push coming from kind of multiple pieces of the market to basically get closer to the source of renewables, and provide that kind of transparency and traceability, and actually be able to bring direct access to renewables. What does that mean? That means moving from unbundled to bundled. And I get asked a lot, what's the big difference there? The big difference is simply being able to point to a specific asset and being able to buy and source your energy and your RECs together and provide those basically through to whatever your end user is. From a technology perspective, last point I'll hit on is just, this has been a very manual tracking process. The traditional ETRM systems, have struggled basically to meet the needs of RECs. It hasn't been kind of as prominent as power, gas, the other commodities. And so there are a lot of organizations that still manage basically their REC business out of spreadsheets, whether that's, transaction capture, whether that's your inventory, whether that's tracking your actual transfers and retirements. That transaction life cycle has been a very manual process. And so, I know there's a big focus in the market from the vendors out there, as well as companies looking to say, how can we automate this? How can we get this into platforms where we can actually trace these the way we do the rest of our commodities?
Yeah, okay, thank you, Jonathan. And on that point, could I move on to Joe, please? And there's actually a lot to unpack in everything that's been said so far, and we've got another audience question coming in. But for now, could I just ask you to concentrate, we'll go for another deeper dive into the RECs markets, and tell us what you're seeing your clients struggling with in those markets. Does it resonate, what the sort of challenges that you were hearing Jonathan talking about?
Yes, it does. I mean, I think he hit the nail on the head when it came to how clients are currently managing their REC portfolios. And these REC portfolios have grown pretty significant. And I think, in the past, I don't want to say they weren't looked at with importance, right? But you could handle it via spreadsheet. You just would, accumulate them over time. You would then retire them based off of your need. Well, now as the market's changing, they're getting more volatility. They're increasing in price. I mean, I just look back when I, kind of age myself, when the, REC market, kind of first stood up in 2010, 2011, there was a big push that this was going to be the next big thing. Some of the stuff in the Northeast was trading at $350. And then, that flattened out to $3, right? Well, now we're starting to see kind of that volatility go up, and you're seeing, I think another thing is like the consumers, right, are driving, the need, like they're looking for green power, whereas before, they're willing to pay a higher cost, right? So, I live in Dallas and ERCOT, right? And I can go to any marketer, and I have the option to go and buy 100% renewable. In the state of Texas, the marketer can still supply that, as dirty power, but then they do have to go get the renewable credits to cover that, right? So obviously, since the market demand from the customers is raising that, there needs to be more systems, processes, et cetera, developed, and that's what we're seeing. Miles, from just an overall operations perspective, not to pile on to what was said, but I think some of the challenges that I've seen with clients, if you look at renewables and RECs and net zero, it's still a regional based kind of regulations. You have some states that are all in. You can look at Oregon, right? 2040, they're looking to have true net zero, zero emission power. You have other states that don't have anything out there, right? So each client that we work with has kind of its own unique challenges. But if you look at, if you're a utility, what are some of the challenges you had? It was said before, your load profile is changing, right? We went from everyone, going to work, working in office buildings during the day, coming home, right? There was that shade, right? Now you have a split workforce, some people from home, some people in the office, right? So that is increasing consumption. You have, the EVs, right, coming home at night, right? So I've seen, clients who are struggling on figuring out, well, what does that new load profile look like, right? as it's changed. Also, with the influx of renewables maybe behind the meter, right? You have this flexible power now that that's coming online. How do they track, what that's going to bring onto the grid? Some other thing, flexible power, et cetera. The congestion challenges that we talked about earlier, right? We're seeing a lot of clients trying to figure out across the board, right? Whether it's a client who's a supplier, whether it's a consumer, right, who bought this PPA thinking that they had zero exposure. Now they're starting to see, oh no, I do have exposure based off of nodal basis risk, et cetera. And then so then how you can kind of leverage different instruments, right, to mitigate that. And I just think all of those are just going to continue to grow over time as we see this more and more influx of intermittent assets across the grid.
Yeah. Okay. Thank you, Joe. So sticking with these operational challenges, Sinu, could I ask you to talk now about the different things that Joe mentioned, and perhaps starting off with the RECs market and the sort of difficulty of tracking RECs and understanding your exposure?
Absolutely, yes. The panelists have spoken about the challenges that come with tracking these renewables, and traditionally the ETRM systems. What has happened is, initially when these RECs came in as novel products that need to be handled by the ETRM systems, it was seen as another physical product that gets delivered physically, and people trying to shoe in these renewable products, not just RECs, it could be any of these compliance market products. It was just trying to fit it into something that's already there. But there are some specific challenges associated with these credits and certificates. Essentially, first of all, the jurisdictions and vintages, how do you track them and how do you decompose them and report the risk, and the valuation of those, and how do you mark them, correctly identify and mark them, and then operational perspective when they get delivered. Right now, if you're trading with an exchange, it's very standardized. When it's going to be delivered. Now, if there's unit contingencies involved and you're dealing with a counterparty, it could be delivered before or later, or the vintages could be slightly different from what you contracted. The contract would allow that. How do you track that? How do you track something else got delivered, or how do you track something got delivered earlier than expected, because the payment date is based on that delivery. You need to pay the client 3 days, 3 days later, pay the counterpart. So all those things were not really smoothly handled. Yes, somebody can sit in an ETRM for a long period of time and make this happen manually, but that's not what the clients are desiring. This is something, it's a major risk exposure, and they want to have all these things streamlined, and that's what we're working on as well. These products need to be streamlined, and I think we've been quite successful in trying to get these dynamics, streamlined, and somebody could click a button and go through it. Obviously, there are additional challenges involved when the voluntary markets come into place, and we need there's this bundling and unbundling, and then how do you retire it smoothly? Just by tracking the molecules or the electrons, along with the renewables. So those are the system-specific challenges that we're working on. But we've been able to make a lot of progress on the compliance markets. Now the wild card is the voluntary markets, which is still evolving and which we are tracking.
Okay, thank you, Sinu. I'd like to put the audience question now, and I'd like to put it to Jazib first of all, please, and then Rohit. And the question is, among wind, solar and storage, what's the most attractive sector today for an equity investor on a return risk basis? Are there any areas where competition has driven returns to unattractive levels? So Jazib, and could I ask you both to answer in fairly short space of time, because we've still got a couple of other topics that we need to get to.
Yes, Stella. So, funnily enough, we can mix the topic we're going to talk about interest rates into this question.
Great.
So I think we can cover two things with one stone. Speaking of analogies, I'll start with Warren Buffett's quote around, he said something about only when the tide goes out, do you sort of figure out who's swimming covered or protected and not. I think this rising interest rate environment is a good opportunity to understand what that means, where cost of capital has gone up substantially for people, where you were getting debt at 2 to 3%, and now you're getting that same debt at like 6, 7%. That is changing the economics for a lot of people, which just ties into the question that was being asked around what do we think about wind, solar storage, and other assets? What do you think how attractive they are from a risk-return perspective? And I think this rising interest rate environment is going to expose who has a good business model, who has a good location, who has the right risk mitigants in place to understand what sort of makes sense. So in that context, I almost sort of break it out in terms of like the utility scale versus the sort of the distributed generation side of it. Right? In wind, we had a long history of generation coming online and capital at very attractive levels and tight levels and hedges, and then Uri kind of exposed that business model, and there's sort of somewhat less money coming into some of those markets. The structures changed from a wind perspective, but then some of the choices locations have been taken. So you take some of the distressed assets which are good location, you can buy it cheap. So wind could still be very interesting. It just kind of depends, what your entry point is based on, what troubles some of these, assets have had in the past. Solar and storage, we talked a little bit about in terms of, what's happening on the regulatory side and the clarity around the ITC and the extension of that, and does that make it a lot more attractive today in terms of much more clarity around those cash flows. But again, we sort of talked about what if it there is too much of those assets coming into a particular location. So again, that makes it less attractive. So again, the location, I wouldn't say like, hey, any asset class, none of it works. I think the location matters and the market matters and your business model matters. But some are easier and than others. Like, I like the distribution generation model more, where we are putting solar and storage and energy efficiency and other stuff and other revenue streams in one single place. So that gives you more ability to withstand some downside risk associated with certain market pricing and things changing. So the business model in my mind matters more, and why somebody's making money. But some of the business models don't make sense. You're looking at people who are investing equity at 7-8% with assumptions as to where prices are going to be in 10, 15 years times, and that sort of seems unsustainable or highly unlikely. And it could happen. We could be living in a different world, but sort of on a probability adjusted basis, the way we sort of think about it is like, what's a realistic scenario? What's the downside? As we make investments, we're very focused on making sure we're protecting our downside, we're protecting our investors, our capital that they've entrusted in us. So we're being careful.
So are you saying it's not so much about whether it's wind, solar, or storage, it's more about the business model of the actual asset, the location of it, judging it each one on its own standalone basis? Right.
Yeah, in each case is kind of very different. It's very, very, very unique.
Yeah.
Where it is, where that market is, what you like about it, and that's gonna, that drives our decision.
Yeah. Okay, Rohit, what do you think of that?
Yeah, Stella, and also in the interest of time, I'll say that I couldn't agree more with Jazib. My thoughts are more or less the same. Again, location matters. The business model probably matters even more once you've found a good location for your resource. We talked about batteries. Batteries have different use cases, so it's a little bit difficult to answer this question. I think I would have perhaps asked the question differently. For example, I would have, I think a better question in the context of today's markets is, does a 1-hour battery in a specific market make more sense or less sense than a 4-hour battery in a different market in a different location? I think those are the kind of questions we ask ourselves, not so much, does wind make sense? Well, where, how, business model. Another thing with the IRA, solar is now eligible to elect for PTCs. And I suspect that a lot of projects and sponsors are going to elect the PTC. However, if you look at wind projects that elected the PTC and then had some sort of hub settled structures, well, that didn't work out so well for those projects. So because of the negative bidding and so you're sort of trading off congestion with curtailment. You're saying I will take less curtailment potentially no curtailment by bidding in at lower prices, but significantly more congestion. So what's your business model? What's your revenue stream? And so those are the kind of questions we ask ourselves, and when we develop projects in certain locations and in different markets. In different markets, again, in some markets, it will make sense to elect the PTC for solar. So we, like I said, echo Jazip's comments. This is not a straightforward question to answer. There's no simple answer.
Okay, thank you. Now I wanted to move on to do a deeper dive into the price volatility of the market at the moment, because it is so key. And looking at the challenges of managing the increased amounts of renewables that are coming onto the grid in terms of intraday trading and shorter term structures. Jonathan, could I bring you in here, please, to talk about your experience here? If you could,
Sure.
We've got 10 minutes left, so you've got a couple of minutes to answer this. That'd be great, thank you.
Sure, and I think this dovetails nicely off of what the statements just made. There used to be kind of a mantra of, hedge it and forget it. And that's a dangerous strategy, and that's been proven out, with the volatility we've seen in the market, whether that's Winter Storm Uri or other events. You've got to know what residual risks you have. And so in terms of, what has an attractive versus unattractive level, it depends on the residual risks and how those are being managed, and what the business, is around that, and how much, merchant risk you're willing to take, and how it's being managed by, for instance, the developer, and what they've taken to market. So, just going to the highest level, and then I'll look at the generation side and retail side very quickly. But of course, renewables have brought more volatility and intermittency. That intermittency brings changes to the generation stack, hourly pricing shape. If the ISO misses the forecast, wind or solar doesn't show up, that's expected, we can get wide swings in the market. We have talked some about storage and looking to fill some of those gaps, but we're still far away in all of these markets to a stable grid, and that's been proven out in the last years. There's beyond storage, there's a wave of kind of not just innovative, what I would call structures, but also, controllable loads in the ERCOT market, like crypto. You've got DG assets for, trying to ensure resilience. And so I would say it's not just from a trading perspective or product perspective, but also just looking at how do you pair, resources, whether that's gen or whether that's controllable load, to basically firm up those hours. Turning quickly to the generation side, really when I spoke about managing the residual risk, that hedge it and forget it, where it was an as produced, for instance, off of the renewable at a node, with the move to more liquid hubs, the fixed structures that have been there, understanding the intermittency and basis, and having the sophisticated tools to be able to manage that, or to hedge that out to those that want to take it on, whether it's a reinsurer, whether it's a trading entity, or whether it's building out your own internal portfolio management or trading desks that look at both long-term exposures and short-term exposures, operating in the day-ahead markets, the real-time markets, the congestion markets is absolutely paramount and key to make sure you're actually able to not only manage risks, but then the opportunities in the market to deliver on those returns. Looking at the retail side, which is what I'm operating on a day-to-day basis now, the push with renewables into the grid and that intermittency, it brings about a need to really understand even deeper than ever before, what does your hourly profile look like? How can it be stressed? What's your exposure by the hour, and where can you hedge those in the market? As I mentioned, whether it's the short-term market, whether it's through insurance products, whether it's through tolls off of storage, all of these pieces have to be brought together, whether you're on the gen side or whether you're on the load side. That portfolio management is absolutely paramount, and then having the tools underneath it that have been spoken about, whether it's analytics or even the ETRM system to basically capture and be able to give you the views that you need to into your portfolio.
Yeah, okay, thank you. So talking about that granularity, sticking with that, could I ask you here to come in and talk about what you're seeing people needing in terms of the granularity of data capture and shape analysis, etc.?
Yes, absolutely. I can totally into what Jonathan was talking about in terms of understanding the risk. So you put on some trades, but you need some analysis to first bring transparency and report that risk and understand the risk and understand what the residual risk is not hedged. Whatever is your open exposure. To do all that, you should be able to, again, you need to be able to capture data at the most granular level, hourly shaping, but you can bring in all the detailed data as you need and start churning out analysis, but it needs to be done in a timely manner. Only if it's reported on a timely manner, you can do something about it. So, that's the balance that we need to hit, from systems perspective as to, all right, I have all this granular data I can get into, but I need to produce this risk reports and all that in a timely manner. I cannot run forever, take this data, I have more resources with cloud and a lot of new technologies coming in. Still, what's the way to optimize? We're looking at scalars, for the forward market, not necessarily capture everything at the granular level for the forward markets, capture it at a more monthly level or daily level, and then apply a scalar that takes it into hourly or sub-hourly shape that can be applied necessarily by, like, these weekdays, these hours, I want to apply this scalar, and then different weekdays different. So kind of bring a general framework to it and apply the scalar. So do optimizations, still produce usable risk reporting that people could use to understand and manage their risk. And so that's one of the things that we've done, and we keep enhancing it as we go. And I'll hand it to Joe probably.
Great, thank you. And Joe, I also wanted to ask, in the interest of time, and we only have about 3.5 minutes left now, and we haven't covered the issue that a couple of people have mentioned, and you mentioned yourself earlier on, the tax implications, the IRA issue. Could you talk about what impact you think that's going to have? If you could briefly explain what it is, and then talk about that.
Sure. Yeah, so the Inflation Reduction Act was passed obviously earlier this year. Huge impact. This is a huge push for renewables. I think a lot of people don't realize it is bipartisan, right? I know with obviously yesterday being election day, there was concern, if there was a big change in power, would this be retracted? But if you kind of look at it, there is quite a few benefits in there for, I would say, areas that are going to be affected by the move to renewables, right? So like where coal plants exist, where fossil fuel assets exist, right? Investors do get tax credits, right? There's tax opportunities for them to invest there. So if you look at it, there's kind of a couple different tranches, which we already talked about. You have the investor tranche, where there's opportunities for people who invest to have significant tax credits, and there's different levels that they can hit. Obviously, for the folks who are actually running it, there's tax credits. The manufacturers, I think, is a big thing to try to pull a lot of the out stuff that's been offshore back to the U.S. There's manufacturer credits. I mean, if you just holistically, I know we don't have a lot of time, but if you look at the tax credits, $300 billion, you can do some fuzzy math that equates to about, $1.1 trillion of investment that's going to come into play over the next 8 to 9 years, depending. 2032 I think is the cutoff date, but it also depends on how much green power we get. So they're going to see a significant investment come to play into this area.
Okay, thank you. So unfortunately, we're almost up to time now with this. We could keep going all day, I'm sure, but we're going to have to leave it there now. So I want to thank our 5 panelists for giving us your time and your wisdom today. Thank you so much. Jazib Hassan, Rohit Ogra, Jonathan Hargrove, Joe Cattarella, and Sinu Kaliamurthy. Thank you so much. And to our audience, I hope you found this very interesting and useful session. And thank you very much for watching. Hope to see you again soon. Goodbye for now.